Hello, everyone. Welcome to video 7 of chapter 2. So now that we've discussed sort of the administrative requirements, when do we file, what are our due dates, what installment calculations for individuals and corporations, now we'll revisit tax planning with a key identifier on tax evasion and what it is and what happens to those who do it and those who help taxpayers do it. So starting with tax evasion is a criminal act. It's deliberately ignoring a specific part of tax law. Now, the biggest ways that people do this is A, not reporting income, which is if you ever have a job where you hear the phrase being paid under the table, that is employment income being paid to you that's not going to be reported to the government. Since it's not being reported and you don't declare it on a tax return, your income is lower than it actually is, and the tax calculation based on it is therefore going to be reduced. So you're not going to pay certain taxes. You are evading them. The alternate way to do it is to inflate expenses. If you have certain deductions that are allowed to subtract from income, exaggerating those expenses will further reduce income, thereby evading taxes. So if you perform tax evasion, it is a criminal act and therefore has criminal consequences. You can be prosecuted, it can go on your criminal record. And if you're found guilty of tax evasion, you will have to pay penalties equal to 200% of your taxes. You'll still owe the taxes you should have paid, plus 200% on top of that. So you might end up paying 3 times the taxes that you would have paid if you just kept it truthful and honest from the get-go. As well as the penalties, you could be incarcerated for up to 5 years in jail. So, other than tax evasion, we mentioned tax avoidance and tax planning are altogether fine. Tax rules are allow us to review our financial position and incorporate the best tax outcome for ourselves. But tax planning does have, I guess we could say, an underhanded scheme to it if we are following the letter of the law, but contravene or disobey the object or spirit of the law. Certain laws are in place to allow small business owners to have more funds for reinvestment, protect family farms for when they get passed down generationally. So, tax law sometimes has these intentions behind it. Now, if you're partaking in transactions or moving your finances around in a certain way that is technically legal, but goes against the spirit of the law, then you are trying to avoid taxes. Now, the CRA has, or the Income Tax Act has anti-avoidance rules. Now, the key concept when discussing if something follows the general anti-avoidance rules is, was there a tax benefit? Did a person partake in a transaction that's conferring to them a tax benefit? If there's no tax benefit, if there's no way that this is reducing or saving us taxes, then how can we be avoiding taxes? We look at a tax avoidance transaction. So what they'll do is they will look at transactions to say, is this person affecting their financial position, or is it a business transaction? Or is it a transaction they're taking part in to avoid taxes? The example in the textbook is someone wants to sell a building from their business, but the capital gain in 1 year is going to really bump up their income level. So they're going to get into a higher tax bracket. So they say, well, what if I set up a new company, sell the building to them on a payment plan over 5 years, and then they sell the building to a third party and get the cash all at once? Because the cost base going from my company to the holding company and the holding company to the customer is the same, the new company won't have any capital gains. My original company will have high capital gains, but because the payment plan is now splitting it over 5 years, I'll have 5 years in a lower tax bracket instead of 1 year in a high one. But there's no economic difference from the transaction between me and the third party. This company only exists to avoid taxes, to reduce my income and spread it out over 5 years. So that is a tax avoidance transaction. So this rule is being misused or abused with the purpose of convening a tax benefit. So the anti-avoidance rules will look at that and say, okay, that's, for lack of a better word, a shady transaction. So we're not going to allow its consideration. So you're not going to get to spread your gain over 5 years. We're going to recognize it in 1 year, as you should have if you had done the transaction properly. So anti-avoidance rules used to be much more specific, but the thing is, whenever they took people to court for avoiding taxes, they lost pretty consistently, and that's because anti-avoiding, or so avoidance transactions do often follow the letter of the law. A person can legally construct a company. You can sell buildings between two companies. So by the letter of the law, they're performing legal transactions, but the economic substance of the transaction is only for the tax benefit. So they've sort of changed the rules to be much broader. It allows the courts to look at transactions with a more analytical methodology, which means it's not just, is this transaction legal, but is this transaction being carried out in a way that makes sense for the business situation and not just for tax benefits. So they want to make sure that if someone's partaking in tax planning, they're doing so fairly, that their transactions have an economic substance. That way, everyone's being treated fairly across the board instead of a handful of business owners getting a benefit because they can afford to do these certain tax arrangements. So, highlights of the new legislation talks about the preamble to remind of key considerations. So the anti-avoidance rules are trying to get to fairness, certainty, and to make sure transactions have an economic substance. They reduce avoidance transaction test from a primary test. It used to be, was this transaction to save taxes, to one of the main purposes. So, is the tax benefit one of the key considerations for the transaction, even though there might be other considerations? The economic substance test is basically trying to figure out, would a person partake in the transaction this way for economic gain? Is there a real business reason for doing the transaction, pardon me, in this way? Introduce an 25% penalty. So there's an additional penalty for those caught under the anti-avoidance rules, and extending the reassessment time from our original 3 years to 6 years. So they only have 3 years to assess the transaction, but if they find that this transaction is being done um, in a way that it gets caught by the general anti-avoidance rules, then they can extend it to 6 years. So if 4 years later we say, well, there is this change that we want to do, and we think this person was intentionally misusing this tax law. So that's tax evasion and tax avoidance. Now, I file my tax return. I owe taxes, but I haven't paid. Well, the government has certain procedures they can go through to get their money. If I have employment income, they can file a garnishment to make sure that when I get paid from an employer, they'll add the repayment of tax into my source deductions. So my source deductions will increase until those unpaid taxes get paid off. They can also garnish a payment made to a taxpayer from others, meaning if someone else owes me money, let's say I have some court case, then they can perhaps get in on that payment and garnish that. Because what if I don't have employment income? What if I have a business owner and my business has transactions with customers? Then maybe they can garnish a certain payment that comes to me, whether from customers, a rental property, or a court payout. If the government owes me money from certain credits, they can redirect those payments away from me towards the tax balance. And if push comes to shove, they could seize some assets. So I'm not paying them anything, but I'm a business owner. I don't have employee wages. They can't intercede with any, court payments, and I'm not getting any credits. They don't have any of those alternatives. Well, they might freeze my bank account or seize my assets and say, okay, you'll get these assets back when you pay what you owe. Now, they can't just jump to these collection procedures. There has to be a reasonable extension of time for me to make my payment. So if I have a notice of assessment and I'm not filing an objection, they have to wait 90 days or about 3 months. They send a notice of assessment saying you owe $6,000, and then they have to wait 3 months of non-payment before going through collection procedures. But what if I do have a notice of objection? Okay, well, now there's 3 months from the date of that notice from CRA. The appeals let me try that sentence again. 90 days from the date of notice from CRA for the appeals division confirming or varying the assessment where objection is filed. So my notice of assessment, I have to pay within 30 days or they can go to collections. If I do want to object, then they have to wait for that tax court to have a decision. Once the court decision's made, now I have 3 months to make the payment on my own before they go to collections. If the appeals division or the tax court uh, come up with a decision, I say, no, I'm going to fight it in a federal court. Now I have to wait. They have to wait until the new court decision. And then they have to wait 3 days after that. So as long as I'm intending to further my objections, they can't force collection from me until the matter is sorted out. But the thing is, court cases can sometimes take months or years to get to a court decision. And the entire time interest is accruing. So if the court goes against me, if the court says, no, you lose, you have to pay the taxes, I might have to pay 1, 2, 3 years of interest on top of it. So even those individuals who mean to object to a notice of assessment might still pay the tax balance now to stop any interest accrual. Then they'll go to court, and if they win, the government will pay back those taxes that they owed or that they pay that turns out they didn't owe. So collection procedures can only come into place if time has passed and a person hasn't been making payments. So if you fail to file a partnership return, repeated failure to report income of at least $500, or penalty in a current year and in any of the 3 preceding years. So basically, if you're not reporting your income. So if I'm not reporting my income, there might be a penalty specifically to that for $500. Now, the penalty is usually the lesser of 10% of unreported income or amount equal to 50% of the difference between understated income tax and the amount of any income tax paid in respect to unreported amount. That's kind of a mouthful sentence, but basically saying the amount that should have, so 10% of unreported income or 50% of the difference in the tax you should have paid. If you lie or you have a false statement, this applies in case of gross negligence, which means a high degree tantamount to intentional acting, meaning the CRA, I have filed my tax return and the CRA thinks I'm lying. Now, the CRA can reassess my numbers and I can say, no, here's my documentation. The onus is on me to prove the support for the numbers I filed. But if the CRA looks at that documentation and say, we don't think this taxpayer is being truthful, it is up to them to prove gross negligence and criminal penalties. So they might say, hey, he's partaking in tax avoidance and rules. Okay, how is he partaking in tax avoidance? But if they want to push to criminal penalties, they need to prove tax evasion. So the burden of proof is on me to support the numbers I put in the tax return, but the burden of proof is on them if they want to push any kind of gross negligent or criminal penalties. Now, let's say I am a tax advisor, someone who has a lot of income comes to me, they say, I want to file my tax return in a certain way to save me taxes. Um, Most tax preparers who prepare more than 10 income tax returns are required to register with the CRA and e-file. This has been reduced to 5. So if you file more than 5 tax returns, you should register with e-file. I think I only file like 17 in a year. I have an e-file number. So taxpayers who do not e-file may be assessed a penalty of $25 for each paper filed T1 and $100 for each paper filed T2. And the penalty is the greater over $1,000 and penalty assessed to clients, which means if it's determined that a client is misreporting their income, intentionally, because I helped them misreport their income, I will be hit with either $1,000 penalty or the penalty assessed to clients. The client will get assessed a penalty, and I might be assessed the same penalty. Now, this penalty is capped at $100,000 plus gross compensation entitlement. So what that means is the penalty is capped at $100,000. Let's say the client has a tax plan to save $1 million. So their penalty of 200% might be more than that, 2 million. Now I helped them do it, but my penalty is going to be $100,000. But I'm not conferring a benefit to myself, right? Like someone comes in my office and says, "Hey, I want you to help me lie on my tax return for so I can get $1 million." Why would I do that? I'm not getting anything for it. It's my designation. So likely the person's going to offer me money. They say, well, the penalty is only $100,000 maximum. What if I pay you $200,000 to do it? Even if we're caught, it's just 100,000, right? You come out ahead. So the government says, no, the penalty is $100,000 plus whatever you were paid to do it. So if that person paid me $200,000, that 100,000 gets attached to the top. So now 300,000 is my total. So I have to give up anything they paid for me to do the arrangement plus a penalty of up to $100,000. You also have people who promote abusive tax shelters. So if they participate in a misrepresentation, making or furnishing false or misleading statements, being involved in the development of an abusive tax shelter. Acceptance of a fee for a transaction that would be considered tax avoidance under GAR may be subject to the reportable transaction rules. So what this means is there are what we call tax shelters. There are things that can be done to reduce taxes. This falls under the avoidance rules, right? So if I, as an accountant, or if I work with a lawyer and we set up that new company, or we set up a charity that's not actually doing charitable work, but is just functioning to save a person's taxes, we might perform professional services to make it easier for this person to avoid taxes. Because we've had a hand in it, we can be hit with GAR rules ourselves as preparers because we promoted these arrangements. These legislative initiatives enable the CRA to obtain information critical to performing their audit function without having to resort to obtaining compliance orders. So what it is the CRA can now look into these tax arrangements set up by professionals to make sure that they have real substance. The charity we set up, is it partaking in charitable activities? This new company that's handling that building purchase, what are its other business transactions? So it allows the CRA to ask certain questions and look at certain information to make sure that professionals are not using their arrangements to promote tax shelters. Okay. I think I'm going to try to push through the last handful of slides. If you own a business, that business is collecting amounts of money. It's collecting sales tax and it's collecting source deductions. Now, those amounts are supposed to be remitted to the government. That money is not getting paid to the company. The company is just holding on to the money until it goes to the government, until it can be remitted. But cash flow is a very sensitive subject under businesses. And sometimes a company might use that money to bridge shortfalls in cash flow, hoping that next month they can make the money back before they pay the amounts. But what happens if they have insufficient corporate property to satisfy these outstanding obligations? What if my business owes a bunch of money? I have some sales tax and source deductions. So I say, well, why don't I pay that debt? When new revenues come in a couple weeks, then I'll use that money to pay the government. But then the sales don't come in. I didn't make the money. Now I don't have enough money in my bank to pay the government what they're due. So the late remittances can go to the director, to me, the business owner, to say, you were supposed to hang on to the money for the government. So since your business can't cover the obligation, you personally will have to cover it. And they can come from me personally and my assets and money to cover this, I guess, this overcharge or this shortfall in the corporate payments. So this does not extend to corporate income tax. The corporation owes money from its profits. This applies to sales tax and source deductions because those are amounts held for the government. The business is just an intermediary. They're not supposed to be using that money. They're just hanging on to it so the government can collect it. But there's several formal steps need to be taken to apply the director liability provision. Basically, the CRA has to says there's a shortfall in your cash, which means you used government money. So they need to prove or at least substantiate that the money used was owed to them and its usage was as a result of your decision. Legal representatives can also be personally liable for tax obligations of another person to the extent the property of the other person they control. This is a big set for executors of an estate. So someone passes away, they name an executor. That person has control of all of the money. Now, let's say the beneficiaries are really pestering the executor. They're saying, well, I want my money. I want my money. And the executor says, okay, they take the bank account, they distribute it to the heirs. But then the estate tax return goes through and says, oh, you should have held on to $10,000 to pay the taxes. And I didn't do that. Well, now they're going to come after me, the executor, because the money was my responsibility. It was up to me to make sure that the funds were used as they were supposed to. So I have to make sure that probate's covered, taxes are covered, any other bills or legal fees have to be paid, and only from what's left can be distributed to the family. So any unpaid income tax obligations of a state that remain unpaid after distribution of assets are the responsibility of the executor. So the executor has to pay up the shortfall. But now a tax return's been filed, and I said, okay, so the taxes have been paid. Now I can distribute the funds. You can request what's called a clearance certificate. A clearance certificate is sort of an invitation to the government to say, hey, do you have any final checks you want to do on this estate before I give the money away? And if the government says, no, you're good to distribute, then that's not on me anymore. The government said I was good to distribute, I did it. So if they've reassessed the tax return and says, oh, there's a small amount that still should be paid, the clearance certificate helps protect me as the executor. I filed the return to the best of my knowledge. I invited you guys to take a look at it. You provided a clearance certificate that said we were good to go. So clearance certificates help protect the executors. Um, if there's a transfer of property from a taxpayer to a taxpayer's spouse, a person under 18, or a person who is non-arm's length of taxpayer. So when we talk about avoidance transaction, a lot of them are with family. And it's any transaction that they pay particular scrutiny is when money's been transferred, but the original person still has control over it. So for persons under 18 years of age, let's say I'm making a bunch of money, I'm in a high tax bracket, and I want to make some investments. But any further investment income is just going to increase my income in the high tax bracket. So I say, aha, what if I gift money and shares to my child? My child will receive the money. Gifts are non-taxable. And now all that investment income is in their hands and they're in the lowest tax bracket. But the CRA will look at and say, okay, but after you gifted the money to your child, you, as their parent, still have control over it. We often have parental guidance over the money and financial decisions of our children. So, yes, it was in your child's hands, but because you still had control of it, we're going to attribute that income to your income. So I can't use this plan to save myself taxable income because they're just going to tack it right back onto mine. So that's what this is greatly looking for. Now, once your child is over 18 years of age, once you have an adult child, now the gifts is probably less of a concern. The anti-avoidance rules likely won't come into play because they're an adult. They can make their own decision. Non-arm's length has to do with anyone who's family member. So over 18, there's still a person with non-arm's length with taxpayer, but they will have to confer or have to determine that I'm still somehow the benefit of the transaction. So if I partake in a business transaction with my brother, I have a lot of income in my company, and I say, hey, he's my finance manager, and I pay him out. The anti-avoidance rules will say, well, you're his only client. You're clearly just trying to split the income. So they'll look more at the transactions. But if I just gift some money to my brother or I gift some money to my adult child and they make investments and they have the income, then it's probably not really for me. I don't have control. The benefit's no longer for me. Person who received property are personally liable for any tax obligations of taxpayer who transferred property for the taxation year. Excuse me. So the person who received the property, let's say I sold a car or I sold some property to save taxes, they're now personally liable for the tax obligations of the taxpayer. So if there was an arrangement where I'm owing taxes, let's say my corporation's owing taxes, but then I transfer the shares to my brother and I say, oh, here you go. There, now the taxes are your problem. He becomes personally liable. So they do this to make sure that it's not, there's no incentive to the person receiving the property. Yes, they want to take on the shares, but they probably don't want to take the tax obligations. Um, Legislation does not generally apply to transfers of property between a tax debtor and an arm's length person, meaning if I transfer those shares to a third party, not a family member, then this anti-avoidance legislation won't come into play because I have no control nor benefit. The benefit's not in the family unit. He's just some guy. So I gave him the shares, or I sold it to him for a discounted price because I needed the money to pay my tax bill. So they're not going to chase him to chase down the taxes. They'll just take the money I took, right? But if I do it with my brother, the government say, hold on, no, you're trying to get away from taxes, and they'll look at my family unit. But arm's length individuals who I have no pre-existing relationship with, that transaction must be fair. I must be getting rid of shares or whatever, or property, in order to get income to pay my bill. Okay, there's only 3 more slides. I'm getting close to 30 minutes, but we'll just push through. So sometimes we have penalties, sometimes we have interest. The CRA is given the authority to waive interest and penalties of 10 calendar years. So let's say I thought I was a non-resident. I didn't file my return for a couple years. I came back to Canada and they said, no, you've been a resident the whole time. And I say, oh, I don't know. I didn't know that. I file a handful of tax years and then I can request that they waive the interest and penalties. I didn't know. I moved away. I thought I was a non-resident now. They might waive some of them. Would they waive all of them? Maybe not, but they might give me a break. They want to encourage people to file their tax returns and pay their bills. So file your return, request penalties and interest, and they might give you a break on those additional amounts. They don't have to pay refunds beyond 3 years, but you can request to get your refund at 4 or 5 to say this was an honest mistake. I didn't know. So just like the CRA can waive the interest and penalties, they can choose to make refunds beyond 3 years. And much in the same way that a taxpayer might waive the 3 year deadline for the CRA, the CRA might do the same for us because cooperation's a big deal when dealing with this authority organization. And they might accept certain late filed elections. Application for waiver must fall into 1 or 3 categories. So I want to waive some interest. Extraordinary circumstances. I was in a car accident. I was in a coma for 4 years. I couldn't file those taxes because I was not conscious. Maybe actions of the CRA. Maybe the CRA sent us a letter and the letter had an error in it. So we never paid a balance. The CRA said, oh, you owe $300. We paid the 300. That was it. But the letter was supposed to say 3,000. Okay, well, there's actions of the CRA. That's why you didn't pay the difference. Maybe they'll forgive it. Maybe they'll forgive the interest and penalties because you tried to uphold your responsibilities. Or if something happens where inability to pay or financial hardship, much like the car accident or the coma, I wasn't able to work, and so I couldn't pay those balances. To confer a good relationship with the government, there's the Voluntary Disclosure Program. The VDP is designed to permit taxpayers to fully disclose previous non-compliance. So maybe I've done a tax return. A couple years later, I've been doing a few tax returns, and I go, oh, this tax law I thought was dealt with this way is actually like this. So I've been doing it wrong. Well, I can let the government know. and they might give me certain breaks on that interest and penalties. Now, in order for my voluntary disclosure to be valid, first it has to be voluntary. It has to be complete. I can't voluntarily disclose something consistently. I can't keep coming back to a tax return and saying, actually, it's actually like this. And then 3 months later being like, yeah, there's something else. I might have done this too. And then a year later being like, there might be something else. So they're saying, no, 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 no. You're coming with your disclosure. Tell us everything you did that you want to change. Because if you keep coming back, then it looks less like this a voluntary disclosure and more like you're trying to give us a heads up before you get caught for some sort of nefarious action or evasion. So the voluntary disclosure helps save you penalties. So there needs to involve a potential penalty in order to save. Include information at least 1 year past due. It has to be for a prior year. Voluntary disclosure for this year is just doing your taxes. Include full payment or must make acceptable payment arrangements. So I made a mistake on my tax return. It looks like I owe $700 more. Here's my $700 now. Please forgive the penalties and interest. So there's a limited and a general program. The limited applies to cases of intentional conduct to avoid detection of establishing offshore bank accounts, gross negligence, penalties waived a maximum 10 years, no criminal prosecution, non-negligence penalties charged, no interest waived. So they're going to forgive you somewhat, but you're not going to get all your forgiveness because you voluntarily disclosed an intentional conduct to avoid detection. So I purposely lied on my tax return and now I'm telling you about it. So they will waive certain amounts. You won't get criminal prosecution, so they won't take you to jail. But the non-negligence penalties might be waived, but the gross negligence penalties can't be waived for more than 10 years. So they can waive some of the penalties, but they're not going to waive all of them. It's limited. For the general program, all penalties waived for up to 10 years, no criminal prosecution, interest partially waived. So the general program is more, I didn't understand the law. I was doing it wrong. Here's the correction. They say no problem. They want people to come forward with mistakes. No problem. Pay us the $700. We're not going to levy anything. But for the intentional, gross negligent, the borderline tax evasion, hey, I did a bad thing. Here's the $700. They'll say, okay, we'll take the $700. We'll waive the interest and penalties for late filing and all that, but we're still going to charge you some penalties for the tax evasion. But the benefit is we're not going to take you to jail. So the voluntary disclosure is you might not be able to save all the money, but you might be able to avoid jail time. Other issues, a taxpayer is only allowed to make one disclosure under the VDP. Again, you are using the voluntary disclosure to save penalties, to save, especially in some cases, criminal charges. So if you say, hey, in 2018, I did some tax evasion, please don't be mad. And they say, okay, you can't 2 years later come back and say, hey, so in 2019 and 2020, I was also doing tax evasion. Please don't be mad. They're like, yeah, you should have told us that before. When you're using this program, tell us everything because you can't just keep coming back. The CRA may require disclosure of advisors who participated in non-compliance. If you want to break on your penalties, who helped you do it? The CRA offers pre-disclosure discussion, so they'll talk you through it first. A second administrative review is available if first application is declined. So I came forward, I told them the truth, here's my situation, but they didn't waive the penalties. Well, then I can reapply and say, I really do think this counts under voluntary disclosure. So that's the program, basically. I am voluntarily letting you know I've done something wrong so that I can avoid certain penalties. So that's the end of chapter 2. Thank you for your time. When we come back in chapter 3, we'll be talking about what gets included in our employment income. So not just the money we received, but additional benefits and perks that might confer a financial gain. Thank you for your time. See you in chapter 3.